Hello, everyone. Welcome to our first discussion here in Accounting 150, Principles of Financial Accounting 1. We're going to be talking about what is accounting, and then, the obvious question, why do we need to understand? Why are we studying this semester? How can it help us? So let's dive in. We'll use these PowerPoint slides to kind of guide our discussion, and so that they may help you take notes and be able to uh, catch the main points that we need to remember. So I want you to think of accounting as two things. First of all, it is a language. It's the language of business is often the term that is used. So just like any language, whether it be a foreign language or the language you have grew up speaking, maybe you have tried to learn a second language at some point in your life, you understand that that's not an easy process. Um, it's easier when you're young than it is as you get older, part of the way our brain develops, but it is still not an easy thing. But we have language for really to communicate. So language is about how well it communicates. It communicates culture, it communicates what's happening. It's much easier in a uh, location if you understand the language to communicate, to get information. Um, if you happen to be in many places in the world, often you can get by without knowing the language, but you will not uh, pick up on what's happening around you in the same way as someone who can understand and speak the language. Uh, like every other language, accounting has some rules because if you don't have rules about how you communicate or what terms to use or how to conjugate verbs or those types of things, if everybody does it a different way, then it's very difficult to understand. And so we have to have rules in accounting as to how things are communicated um, for this language that we're going to learn this semester. So, second thing I want you to think of accounting as is a decision-making tool. Um, for what we're going to talk about this semester, financial accounting, well, our primary decision makers are investors. Those are individuals or businesses, doesn't matter. Those who want to make an investment in a business for some sort of a return. They are going to provide that money to the business either in the form of a loan, which they expect to be paid back, or the form of ownership, where they actually own a piece of the business. Either way, they are looking for some form of return, meaning they want to get back more than they put in. That's what we mean by a return on their investment. That is the key issue. And so that's the decision maker we can't want to keep in mind when we're talking about what we need to communicate, how we communicate it. These are people outside of the business, so they are not internal. They're not walking around in our business every day. They don't know all the jargon, so we need to utilize a way of communicating that will be clear to them, even though they're external to the business. Okay. Um, They also use that accounting information to manage risk. Now, risk is the possibility that the outcome will be different than what you plan. So every day we deal with risks. There's risks to driving, there's risks to that it's going to rain, it's risks about, in our relationships, in every aspect of our life, we encounter risk and manage risk. That's part of living, part of our life. And what we try to do is manage risks to, and it's not so much that we make risk go away, because the only way to make risk go away is to stop living. But we manage it so that it's something we can handle we may trade one risk for another. For instance, some of us are more adverse to certain risks than others. I don't like the risk of going on uh, roller coasters. Other people, I'd rather have my money than go on a roller coaster. Other people would rather trade the risk of not having money by spending money on going to amusement parks because that risk is something that they enjoy and they don't see that as risky as, say, I do. So we trade at risk. What happen in investing? The risk is that we will invest in something that is not going to turn out, not going to provide a return. And one of the ways we manage that is we gather information, because when you try to understand what a company is going to do and whether you're going to make a return, looking at the past is a good way of managing the risk of what's going to happen in the future. Not a perfect way. Again, there's no way to get rid of the risks. For your money, the only way to basically there's really no way to get rid of the risk. Even if you hide it in your mattress, there's a risk that inflation will make the value of your money worth almost nothing by the time you pull it out of your mattress. So there's a risk there. We want to manage that risk by looking at the company's performance and trying to evaluate whether or not that risk is something that we can accept and that the return is worth the risk. But I want you to always remember, if you don't remember anything else, and that is that risk and return go together. If you're going to have a return, if you're going to earn a return, there are going to have to be risks involved. Anybody who tells you that you can have a return with no risk, that means they're trying to cheat you, means they're a charlatan and they're telling you a lie. So I like to think of it in this kind of model, okay? Business owners and managers make business decisions about what they're going to do, how they're going to hire, what products to offer, what to charge for them. All kinds of decisions every day are made. They make those business decisions, which we as accountants, or those who do accounting, are going to observe those. Those are going to result in transactions and documents and things that indicate what those decisions were. And they're going to translate those decisions into accounting decisions to reflect that business and then communicate that to investors and lenders. That's what accountants do. They translate business decisions into accounting decisions, which then get summarized and communicated to investors or lenders for their decisions. Then they make investment decisions. They decide whether to invest in one company, to stop investing, to invest more, that sort of thing. And other people are involved in making decisions. Lots of people have a stake, you might say, in a business. A employee has a stake. They want to make a decision whether to stay with the company, whether to accept that promotion, that sort of thing. That's based on the same idea. And this all works as long as this can be trusted. Okay, as long as the accountants can be trusted to communicate that the rules are being followed, that the information that we're working from can be trusted. Because if you can't be trusted, then you don't know the risk of having no return or bad information is too high, and most time investors are going to go somewhere else, or they're going to keep their money under a mattress, some form of that. So a little more on risk. There's a chance the outcome will fluctuate. They go together, as we talked about already. Okay. Investors are looking for return in two ways. Either they're going to receive interest on their money if they're a lender, or they're going to receive a dividend on their stock if they're a investor in if they're a stockholder, or they could have buy low and sell high, meaning that the price will have gone up. So they want to know if that's going to happen. And of course, the risk is that they think that that's going to happen and it doesn't. There is no return, or the price doesn't go up, or they don't pay dividends. They want to use information to try to predict that as best they can. They will never get to zero risk. It will always be some risk, but the better your information, the more information you have, the more you can manage and pick the investments that have the level of risk that you're comfortable with, because and therefore the level of return that you're going to earn. So you want to maximize return while you manage the risk. And the past is a pretty good predictor. If you think about predicting the weather's going to be tomorrow, today is a pretty good predictor of that. It's not going to be very often, not perfect, not very often that it's going to be 40 or 50 degrees different tomorrow than it was today. All right, so most of the time it's a pretty good predictor. It may not get you exactly what's going to happen, but it'll get you in the ballpark. So that's kind of how we look at financial information, communicating what the past is, so that we can decide what the future is going to be, or at least make a prediction about that with a reasonable amount of risk. So just to give you an idea, this is what's called a stock chart. It shows you the price of Nike stock for the last 6 months. It's a little example. Investors make two returns in two ways. They could have bought here when the price was around just under $70 a share, and sold up here when it was $100 a share. That's a pretty short-term investment. Typically, we're looking at longer, so we could have looked at a longer time frame, but that's the idea. You buy when it's lower price, and because it's going to go up. What causes stock to go up? Okay, that depends on the growth and the success, financial success of the company. Shareholders everybody is trying to do the same thing. Everybody's trying to predict what the future is on these. This literally can be hundreds of thousands of individual stockholders making this decision. And then right here is what's called when the dividends are paid. So you see that every quarter there are a dividend paid in cash. That dividends are a share of the profit the company makes. So this is, if you own a share of stock in Nike, you'll get a dividend that represents your part of the profit that they earn. And we'll understand a little bit more about what profit and net income means as we keep moving through our accounting class here. That's the terms that we will work with. So again, dividends are distributing the profits earned to the business. So our question we're asking ourselves, will Nike have the cash and profits in the future to be able to continue to pay dividends? Will they grow financially in a way that will make the company more valuable and thus make a share of the company more valuable in the future? So that's what the questions we're trying to answer from the financial information that is provided to investors. Companies that are publicly traded, those that are traded on a stock exchange, which you can buy, anyone can buy, not the small mom and pop operations that you might see down the street or something like that, but they are those that are publicly traded are required by the SEC to communicate their accounting information according to a specified set of rules. And the form that's taken over the years is financial statements. And we're going to learn about those financial statements, what they look like, how they communicate that information. But they also provide, and that's considered financial information, they also provide a lot of other explanatory information They make explanations of that financial information, which may not be non-financial information. For instance, how many employees they have, whether that's growing, what their turnover of employees, what their rate of defects are, where they buy their products from. All those things might be non-financial information that may be reported for investors to make a decision about. So here's an example of what comes out every quarter and every year. Nike has to report information. You see that their year ends on May 31st, 2020, not that long ago. And you can see that they have given us some explanation about what their results were for the last year, last 3 months, and what happened with sales, where those came and how they were affected by the pandemic, that sort of thing, in this news release. So this is explanatory financial information. It's not, in the form of financial statements. This is more just words and explanation. Every company submits an annual report to the SEC where they have, and this financial annual report can be hundreds of pages long. This one is, quite long. It looks like it goes down to at least page 96. This is just a table of contents. It's got lots of all this stuff, all these information is non-financial explanation. It may reference some of the financial information. And then item 8 is always the financial statements. As a shortcut, they start in this particular report, looks like on about page 52 of the report. So this gives you an idea of all the ways that a company provides this information. So this is your first income statement or statement of income or statement of operations for you to look at. This is Nike. This is what they reported. Notice that they reported 3 years. Why would they do that? Why would they give us 3 years of information? Because we want to compare. We want to see what the past and what the trend is. And so you'll notice something that, some things that might happen. For instance, sales went up between 18 and 19, but then back down for 2020. All right. Other expenses. These are the costs that it took to earn this revenue. How does Nike earn revenue? They sell clothing and shoes and all kinds of other items like that. So these are the costs to do that, and what's left over is your net income. That's the profit, if you will, left after they've paid for all the costs that it takes to run Nike, everything from marketing, which they call demand creation. Sounds like a pretty creative way of describing marketing. The cost of the shoes and clothing and such. It went down as well as our sales went down. You could speculate as to whether the drop was because of the pandemic. This ended on May 31st, so it included a couple of months of pandemic time frame. That could have been part of it, part of the process. What do we see coming in the future? What does this tell us about their expenses? Were they able to reduce expenses? And notice that operating overhead, despite lower sales, still went up. So you can see that the income or the profit, while doubling between 2018 and 2019, went down substantially in 2020, in the fiscal 2020. A balance sheet answers the question, what resources does Nike control? The assets that they own. These are resources, the things that they use to create income, create revenue. This is the things that they owe, the liabilities. And this down here is the shareholders. What part of those assets they own? This always balances, or assets always equal liabilities and shareholders' equity. But this gives you a way to look at some of the things that they have. They have, for instance, over $8 billion in cash sitting in the bank. They have almost $5 billion, because all this is in millions, in property, plant, and equipment. They have almost $7.5 billion in inventory, stuff to sell, up substantially from last year, perhaps indicating that they had some trouble selling inventory right at the end of May, which is why it's as high as it is. So this is the form, the financial information, and the form that it takes for reporting to those outside the company. And then finally, a statement of cash flows. We will also learn about a statement of owner's equity. They tend to be more complicated in real life than we need them to be right now. We'll get the basics of that in next couple of chapters, and you'll get the real detail about how that works out in a later accounting class if you continue. But cash flow measures what they do with the money. We noticed that their cash is pretty high. They've got almost $9 billion, or $8.5 billion. Where did it come from? What did they use it on? They bought some investments. They bought some more property and equipment. They bought back their stock. They paid some dividends, is the financing. So these are the things that with the banks, you can see they borrowed $6 billion, which is why they're sitting on so much cash. They took out a loan for $6 billion during the year. That's a considerable amount that they have in terms of cash, so that they can weather maybe the downturn based on the pandemic. So that is the idea of what accounting is and what it's trying to communicate, so that we, as those trying to make investment decisions, those that are trying to decide whether they should sell or buy from Nike, customers may use that information, employees, whether or not this is a company they want to work for, whether they can give them a raise, they'll be able to, make good money with this company. All of that is displayed here, and so in a way, and we're going to try to dig in deeper, understand the terminology better, so that we know how we can understand what the story that's being told about Nike in these financial statements, and in the explanation, for that matter, that came before it.